welcome to Fidelity Soundbites, a straight-to-the-point monthly podcast where you will learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioning their portfolio, and the outlook going forward. I'm your host, Andrew Dowling, and welcome once again to Paul Taylor. Thanks for joining us again, Paul.
Andrew, good morning. Good to see you again.
Yeah, you too. And look, plenty happening as always in markets and right across the economy. And one of the really, I suppose, hot topics at the moment is critical minerals, Paul. And they're certainly gaining increased attention both locally and globally. Can you just talk us through what constitutes critical minerals and also just why it's such a hot topic, not only for now, but for the future?
It is a really interesting one. It is very specific for Australia, I think. Australia has a fantastic opportunity in these sort of minerals. Critical minerals are anything that's basically critical to the process, mainly in a lot of technologies, that are important to an economy. It could be things like rare earths, lithium, nickel, cobalt. They're all part of it. But there's actually a vast array of critical minerals. Now, a lot of it is about just getting supply of those minerals for those processes, but a lot of it is also, setting up whether it's production in the US or also sort of environmental standards or ESG standards. You can also look at what's happening in Europe on the electric vehicle and battery market. So the interesting thing is Australia has a lot of these minerals, and we're well positioned because of our high ESG standards. That's labour, that's how we go about the mining process, basically the better quality of those minerals as well. One of the questions that is getting asked in markets is because in Australia we are, mining is in our DNA. We've been really good at pulling the rocks out of the ground. I think we've probably been less good at processing those minerals into end products. And I think that's what's getting asked now is that should we move further downstream? So first of all, you move the ore, you move the products around less, so it's actually taken through that processing near where the rocks are pulled out of the ground. It also ensures sort of provenance of that commodity as well. That the commodities aren't going and getting mixed with other countries' commodities maybe that they don't have the same standards as Australia. So then with EV regulation in the European Union, they know exactly where those commodities have come from, what's been done to get them to that level, what their grade is. The human rights standards in the countries that develop that minerals as well. And in the US, increasingly through the Inflation Reduction Act, the US will look to Australia as almost domestic production. So we are in an incredibly positive position to supply, the world, or primarily US and Europe in these minerals. That's going to help with technology products. That's going to help with electric vehicles, and there's going to be incredible growth in those areas over the next few years. And one of the things where I think is going to be really interesting is there's talk about potentially getting a green premium in some commodity products as well. So the green premium, if it comes from a country that's high ESG standards, better production, higher grade, and you can rely on the processes, to meet regulations in the EU or to meet regulations in the US, potentially, they may pay a higher price for some of those commodities, which they're calling the green premium. So we're sort of thinking about it and thinking, well, actually, this is a really positive development for Australia, and it is, could potentially lead to the decommoditisation of commodities in that the better quality commodities that are coming out of Australia get that green premium. And, we're just at the start of this process. And I think it's a really exciting one for Australia.
Yeah. And looking downstream and looking at sort of where we currently sit, moving from production to processing, long way to go. Are we? Is there initiatives in train there?
Look, it's a really good point. And like I said, mining is in our DNA, and we've traditionally made our money out of pulling the rocks out of the ground, and we're very good at that. I'd say that we've been less good on the processing side, and that we do have to focus on. So I think we do also have to go in with our eyes wide open. And we do have to get in whether that it's partnering with companies that are specialists in the processing side or bringing that expertise into the country where we lack that expertise as well.
And is that the companies that are actually producing the various or mining the various critical minerals that would move downstream?
It could be all different types of people. I mean, the critical thing is just to have the expertise. Yeah. So, you definitely don't want to force the miners to take it further downstream because they might not have the expertise, and you end up in a worse situation. We've had examples of that in the steel industry. If you go back into the 90s, that was one of the negative things that happened as some of the miners moved into that space. They didn't really have the expertise, and it didn't end well. So you do have to make sure you have the expertise, you have the knowledge that can take it to the next level, because it is a complex process. So making sure we either partner with the right companies or bring that expertise in will be critical in this space.
Yeah, and look, in terms of the Australian equities market, how does an Australian equities investor play that opportunity as it currently stands, both now and medium term? Where are those?
Yeah, look, I think
opportunities.
I think it's really just the space. It's more broadly the space. So, where the excitement is in lithium, cobalt, nickel, which are all important minerals that go into the batteries and obviously electric vehicles. It's rare earths that go into a whole range of the technology, the chips, etc. That is critical to our future. It's quite exciting, I think, more broadly for the mining sector in Australia, and we are in a very strong position. But I think just broadly, those as an investor, those broad commodities will work well. We have in a lot of our minerals, it's taken us a long time. We're sort of moving from a fossil fuel environment to a mineral environment, and that's going to be a really interesting move as well.
So, Paul, what does that mean for individual stocks?
For areas like critical minerals and transition materials, we have reasonable size investments in a couple of companies. IGO is one of our larger and one of our main overweight positions, as well as Iluka. Now, IGO is fantastically well positioned in lithium, in nickel. They are, a low-cost producer, attractively valued, and really well positioned in terms of how they go forward. So we think they're based on the cost of production, based on the quality of the minerals, based on the geology of their mine sites. We think they're really well positioned. Iluka also probably, but more so from they're now developing their rare earths, which we think is well positioned, as well as their industrial minerals, and also both are more attractively valued as well. So we would highlight those as areas we think will work well in this environment.
Excellent. And just moving on from critical minerals to, I suppose, something that's been quite critical on everyone's mind, particularly in Australia, or whether you've got term deposits or whether you've got a home loan or otherwise. Yesterday was the D-Day anniversary, but it was also D-Day for interest rates. And I think the growing consensus was that we would see an interest rate rise, which we did. How does that sort of sit with you and the team, in terms of, does that sort of tip the scales towards more recessionary risk, or does that really change the composition of how you now think about certain sectors across the market?
It definitely has an impact, and I think we are at an interesting point in time as well. So official interest rates are now 4.1% after that 25 basis point rise, and if you add a couple of percent margins on that, you're getting into interest rates above 6%, and that will really be having an impact on people with mortgages. As you know, about a third of people rent their homes, about a third of people own their homes outright, and about a third have a mortgage. So it's not the whole market, but it's a big part of the market. We also have this really interesting thing of the interest rate cliff as people have a large part of the market took up fixed rate mortgages when interest rates are very low. They're now starting to roll off. That'll be a process over the next year or so. But really, this coming month will be one of the highest months in terms of those fixed term rates rolling off, just starting to come off.
Yeah.
So that's another factor, in that equation.
Yeah. And that's pretty much going from, it's a tripling, I suppose, isn't it?
It could be. It could be. Obviously, depends on when the person took out the mortgage, but it could be.
Yeah.
So you've got a few interesting things. I think that will definitely impact the consumer, and that is where the focus is. So, if you look at Australia, the government debt has gone up, but it hasn't been too bad. And in fact, you saw last month we had a budget surplus, which is would be quite unusual around the world.
Yeah, indeed.
Corporate balance sheets are in incredibly good shape. The debt in Australia really is with the consumer, so that's where we'll see, the potential pain as interest rates go up. I mean, our base case is that Australia doesn't move into a recession in 2023, but the odds of that, I think, now are increasing as interest rates continue to go up. And the RBA also made the statement that, potentially there'll be more coming. So I definitely think it changes the odds of a recession, and we have to be, prepared for that. We're definitely going to see slowing growth. So, we're already factoring in quite reasonable slowing growth in the second half of 2023. But, potentially could be a bit of a changer for the economy as well.
Yeah. So in summary, Paul, and look, obviously taking into account our discussion on critical minerals, the rate rise, the probability that, that we might see more rate rises from here, does that sort of change anything in terms of the way you're currently thinking about your portfolio and sort of where that might head in the future?
So we got as you rightly point out, we got a few positives and a few negatives. So I think with interest rates going up, we are a little bit more, the risk of recession has gone up. We do have these fantastic opportunities in critical minerals. The transition materials is the other way to look at it in terms of electric vehicles. Another really positive in Australia, I think, at the moment is immigration has restarted. Australia's had very strong population growth over the last 100 years, being close to 2% per year. And coming out of COVID, we've just reopened to immigration again. And that is actually a very positive development because we need those people. We obviously have a range of labour shortages. We need those people. And more people means more goods, more services, more houses. They're all what will work on the back of immigration. And also the diversity of the immigrants will have a big and positive impact on the Australian economy. So we've got some positive developments in commodities. We've got some really positive developments in population growth. Australian government is actually doing quite well on the back of the commodity price. Like I said, we had a budget surplus, which I think is an amazing outcome in this environment. But with higher interest rates, there's a bit of a risk around a consumer recession. So put all that together, and as you rightly point out, we're not just looking at the next 6 months. We tend to look at the next 5 to 7 years as we're investing. But I guess it's fair to say we're conservatively positioned for 2023, and a lot of the overweights that we have haven't really changed that much because I think this is something that's been unfolding for a while. This is. It hasn't changed that much. So our key overweights remain the same in terms of a lot of the essentials. So they're able to pass on higher prices. So inflation will allow them to pass on higher prices. That's the supermarkets and healthcare. We continue to be overweight in those sectors. We're also overweight cheap sectors like the insurance sector, which has also got much better fundamentals, as well as some very specifics around the commodity space as well. Whether it's transition materials or critical minerals. So I think that is a fairly conservative portfolio that is set, and we continue to be very happy with how that's set for a more difficult 2023, but also companies we think are going to deliver really good returns over the next 5 to 7 years.
Excellent. Well, thanks again, Paul. We, as always, appreciate you joining us for the monthly podcast. And certainly look forward to having you join us next month. And if you've enjoyed this episode, please share it with a friend and subscribe to the podcast via your favourite streaming platform. And we'll see you all next month. Thank you.
Thanks, Andrew.
Some important information on today's podcast. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.